Namaste, everyone, and welcome. I'm Professor Yan. So today we're going to tackle a really important concept, something that's right at the heart of all of finance, the cost of capital.
Professor, can I ask something? I get that a company needs money to grow, right? But that money isn't free. So how does a company actually decide if the money is getting too expensive to take on? Is there like a line they don't cross?
That is a fantastic question, Vidya. You've really hit the nail on the head. And to answer that, well, we need to start at the very beginning. Let's figure out what this cost of capital, actually is. Okay, so let's break it down with a super simple idea. You know how if you rent a house, you have to pay rent to the landlord? Well, think of a company doing this same thing, but with money. It's renting money from its financiers. Shareholders, people who give them loans. And that rent it pays for using their money, that's it. That's the cost of capital. All right, now for the textbook definition, and this is where you need to listen really closely. The cost of capital is the return expected by the providers of capital. See that word, expected? I want you to burn that word into your brain. It's everything. It's the whole game right there. Okay, so it's basically the price tag on money. I get that, but why do we, as future chartered accountants, need to care so much about this one number? What makes it so important in the real world? It matters because this number, it's the ultimate yardstick. It's the benchmark, the hurdle rate for pretty much every big money decision a company has to make. Think about it. First, evaluating new projects. Let's say a project promises a 12% return, but your cost of capital is 15%. Are you going to do it? No way. You'd be losing money. Second, how do you raise money? Should you sell shares, take out a loan? Well, you'll look at which one is cheaper. And it even helps you decide your credit policy with customers. It's the financial high jump bar. You have to clear it. Right, okay, its importance is clear. But I'm still stuck on that word you pointed out, expected. Is the cost what the company actually pays out, or is it what the investor hopes to get? I mean, they sound like they should be the same thing, but are they? And that, Vidya, is the most important question you can ask. It's the key that unlocks this whole topic. And the answer is right here in this quote. Cost is not what the company pays. Rather, it is the expectations of stakeholders. Let that sink in. The power isn't with the company paying. It's with the investor who is providing the money. Their expectation defines the cost. Let's use an example to make this crystal clear. Imagine a company issues a debenture, and on the paper it says 9% coupon. That's the fixed amount it pays. But what if the investors in the market, because of risks and other opportunities, won't even consider it unless they can get a 10% return? Then that 10%, that is the company's true cost of capital. It's not the 9% it's paying. It's the 10% the market demands. You see the gap? So it's not about the number printed on the certificate. It's about what the market, the investors, actually expect to earn. That's a huge difference. Exactly. So if this cost is all about what the market expects, what kind of things out there in the big wide world can push that expectation up or down? Oh, so many things, Vijaya. I mean, you've got the most basic economic principle, supply and demand for money. That's a huge one. Then you have things like investor preferences. What are people choosing to do with their savings? And of course, the golden rule of finance. The higher the risk, the higher the return people are going to demand. On top of all that, you have the big picture stuff, inflation eating away at returns, exchange rates going up and down. It's a whole mix of forces at play. Okay, so when we talk about a company's capital, it's not just one big pot of money. Think of it more like a recipe with different ingredients. You've got debt, you've got preference shares, equity, and even retained earnings. Now, to figure out the total cost of the whole dish, we first have to figure out the cost of each individual ingredient. So where do we start? Let's begin with the first, and I'd say probably the easiest one to understand, the cost of debt. And in the world of financial management, we have a little shortcut for this, a symbol. We call it KD. So what in the world is KDOD? Well, it's pretty straightforward, actually. It's the cost that comes with any money the company raises by borrowing for the long term. We're talking about things like issuing debentures, or maybe taking out a big long-term loan from a bank. To figure this cost out, our starting point is almost always the interest rate. You'll often hear it called the coupon rate. You just take that percentage and apply it to the face value, the stated value of the debenture. That tells you the actual cash amount, the interest, that gets paid out every year. It's the most obvious part of the cost. So,
If a company issues a debenture with a face value of 100 rupees and a 9% coupon rate, the annual interest it pays is simply 9 rupees. Precisely. You've got it. It's that simple. That 9 rupees is the explicit interest payment, and it's the foundation for calculating our total KD.
Okay, we've established that the true cost of capital is driven by investor expectations, and we've calculated the most basic component. But this just feels like one piece of a much bigger puzzle, Professor. What about the other parts, like equity and preference shares? They don't have a simple coupon rate attached to them. So how on earth do we calculate their cost? An excellent question to end on. It's a much more complex puzzle, for sure. But for now, just remember that one core idea. The cost is the investor's expectation. If you truly understand that, you're more than ready for what comes next. Thank you for your attention.